Tuple, same age, same salary, same year, both start investing in 2020. Then the market crashes. One panics, stops investing, waits for things to feel safe. The other, scared too but keeps investing anyway. Same income, same starting point a few years later. One is still stuck, checking prices at the grocery store. The other is quietly building real wealth. No luck, no secret strategy. The difference came down to about 6 months. That most people completely missed. Two people, same age, same salary, same year, both are 28, both make around $60,000 a year. Both finally decide, I need to start investing. It's early 2020. They open their accounts. They put in their first few $1,000s. They set up a simple monthly plan. And for a brief moment, everything feels like it's working. Then the market crashes. Fast headlines turn negative overnight. Global crisis, markets in freefall. Worst drop since 2008. Their portfolios start bleeding red. And this is where everything changes. Person 1 panics. They check their account every day. Watch it drop again and again. It doesn't feel like investing anymore. It feels like losing. So they stop. They cancel their monthly contributions. Sell a portion just to be safe. And tell themselves the same thing everyone says. I'll get back in when things calm down. When the news is better. When the market feels safer. When it makes sense again. Person 2 feels the exact same fear. Same red numbers. Same uncertainty. Same voice in their head saying, this is a bad idea, but they don't stop. They keep investing 300, 500 every month, even when it feels uncomfortable, even when it feels wrong. They don't try to predict anything. They just stick to the plan, month after month through the chaos. Then something subtle happens. The market stops falling, not dramatically, not with a big announcement. It just quietly turns. Prices start rising again, slow at first, then faster. But here's the key part. By the time it feels safe again, the biggest gains are already gone. Person 1 finally comes back. The news is positive again. Everyone is talking about recovery. It feels like the right time. So they start investing again. But now everything is more expensive. Meanwhile, person 2, they were buying the entire time, at the lowest prices, during the worst headlines, when nobody else wanted to. Fast forward a few years, same people, same income, but completely different outcomes. One is still living paycheck to paycheck, still wondering why it feels like they were not getting ahead, still checking prices at the grocery store. The other, their portfolio has quietly grown, compounding in the background, building something real. No luck, no secret strategy, no perfect timing. The difference came down to about 6 months. 6 months of fear, 6 months of uncertainty, 6 months where one person stopped, and the other did too. And those 6 months, most people completely missed them.
Now here's the part nobody talks about. It feels rational to stop, because everything around you is telling you something is wrong. Prices are going up, groceries feel more expensive every month. Gas, rent, daily life, it all starts to squeeze.
Then you hear about interest rates. They were rising. Or maybe they were not coming down as fast as expected. Either way, it sounds bad for the economy. Then come the layoffs, tech companies cutting jobs, news about hiring freezes. People around you start getting nervous, and then the market drops. Your portfolio turns red, day after day. And suddenly it's not just numbers anymore. It feels personal. That money, that's your time, your effort, your security. So your brain does what it's designed to do. Protect you. It tells you, stop, wait, don't lose more. Because thousands of years ago, avoiding loss kept you alive. But in investing, that same instinct becomes the problem. When your portfolio drops and the headlines get louder, your brain does say this is an opportunity. It says, wait until it feels safe again. And that one thought, that's where most people lose the entire game. Now let's step away from feelings and look at what actually happens. Because the data tells a completely different story than the headlines. Every major crisis, recessions, wars, crashes, pandemics, the market has recovered from all of them. Not some, not most, all of them. And more importantly, they didn't just recover, they went on to reach new highs. Here's the part most people misunderstand. Bear markets feel long, but they were actually short. On average, they last around a year or less. But bull markets, they last years, sometimes nearly a decade. That's where the real money is made. Now here's where it gets brutal. It's not just being in the market that matters. It's when you're in, because a huge portion of long-term returns comes from just a handful of days. Miss the 10 best days over 20 years, your returns can get cut in half. Miss a few more, you barely beat inflation. And here's the catch. Most of those best days happen right after the worst ones. During crashes, during peak fear, when it feels the most uncomfortable to invest. So when people say, I'll just wait until things calm down, what they were really doing is waiting until the recovery is already over, buying back in at higher prices after the opportunity is gone. The truth is simple. The market doesn't wait for you to feel safe. It moves first, and by the time you feel comfortable again, the window has already closed. This is what most people done to understand. The best returns dumb come from calm markets. They come right after fear. Not when everything looks good. Not when the news is positive. Not when your friends start talking about stocks again. They come when sentiment is low, prices are down, and nobody wants to buy. Think about it. If everyone feels confident, prices are already high. If everything looks safe, the opportunity is already gone, because the market doesn't reward comfort. It rewards timing inside discomfort. The biggest gains happen when assets are mispriced by fear. When people are selling not because fundamentals changed, but because they re-scared. That's when discounts appear. That's when great companies get cheaper. Not because they re-worse, but because emotions are in control. But here's the catch. You don't feel like you're re-getting a deal. You feel like you're remaking a mistake. You feel early, you feel uncertain, you feel exposed. That's why most people don't do it. The reframe is simple. What feels like risk is often the entry point, and what feels safe is usually where returns go to die. Let's make this real. Go back to past downturns 2008, 2009, even smaller crashes in between. Every time the same pattern played out, the people who kept investing during the drop, not perfectly, not aggressively, just consistently, ended up with massive long-term gains. Take a simple example. Someone investing every month during a downturn. Same $300, $500, nothing fancy. When prices fall, that same money buys more shares. When prices recover, those shares multiply in value. They didn't time the bottom. They didn't predict anything. They just stayed in. And over time, that consistency compounds into something big. Now compare that to the person who waited. They paused during the drop, sat on the sidelines, watched the news, waited for clarity, then came back when things looked better. But by then, prices were already higher. They bought fewer shares, missed the rebound, and spent years trying to catch up. This is why timing almost always loses. Because you have to be right twice, when to get out, and when to get back in. Most people fail at both. Meanwhile, the average investor, no special skills, no perfect timing, wins by doing something simple. They don't stop, and here's the uncomfortable truth. The people who waited paid higher prices later, while the ones who stayed in, they got rewarded for doing the one thing that felt the hardest at the time. So if the data is this clear, why do most people still get it wrong? It comes down to how your brain is wired. First, loss aversion. Losing money feels about twice as painful as gaining money feels good. So when your portfolio drops 20%, it doesn't feel like a temporary fluctuation. It feels like danger, like you need to act right now. Second, your brain prioritizes survival over growth. In the wild, avoiding loss kept you alive and investing. It pushes you to sell at the worst possible time, because doing nothing feels risky, even when it's actually the right move. Third, the need for certainty. People don't want to invest when things are unclear. They want confirmation. Good news, stable markets, positive headlines. They want a signal that says, now it's safe. But here's the trap. That signal comes after the opportunity, after prices recover, after the rebound starts, after the easy gains are gone. So what feels like being careful is actually just buying late. The key insight: by the time it feels safe, it's already expensive. And by the time it feels scary, that's usually when it was cheap. So what do you actually do with all of this? Not theory, not opinions. A simple system you can follow even when things feel uncertain. Step 1. Build a core base. Start with the foundation, broad market exposure, index funds, something that tracks the overall market. This gives you access to everything: growth, recovery, long-term trends. You're not betting on one company. You're re-owning the system. Step 2. Add quality assets. Then layer in a few strong companies, businesses with real earnings. Long-term dominance, products people will still use 10 years from now. You're not chasing hype. You're re-owning durable value. Step 3. Stay consistent. This is where everything actually works. Invest every month, no matter what the market is doing. You invest down, you invest sideways, you still invest. And when markets drop, if you can invest a little more, because your money goes further when prices are lower. No predictions, no trying to time the bottom, no waiting for the perfect moment, just consistency, because the people who win long-term aren't the ones who guess right. They're the ones who keep going when it's hardest to. So when moments like this show up, you really only have 3 choices. Option 1, wait. This is what most people do. You step back, hold cash. Tell yourself you're being smart. You wait for things to feel clearer, safer, more predictable, and it feels responsible. But in reality, you're waiting for prices to go up before you buy. Option 2, do nothing. You don't sell, you don't invest more, you just hold. This avoids big mistakes. You don't panic. You don't time the market, and that's better than most. But you also miss something important. The chance to buy when things are discounted. You survive the cycle, but you don't fully benefit from it. Option 3, invest through uncertainty. This is the hardest one, Because nothing feels certain. Headlines are negative. Markets are volatile. Your instincts are telling you to wait, but you invest anyway. You stay consistent. You keep buying. You lean into the discomfort. And over time, that's what builds real wealth. Here's the truth. Only one of these actually moves you forward. One feels safe but costs you returns. One keeps you steady but limits growth. One feels uncomfortable but changes your future. Only one of these builds real wealth. Let's go back to those two people. Same age, same salary, same starting point, nothing special separated them. No insider knowledge, no perfect timing, no secret strategy. One of them didn't predict the market. Didn't know when things would recover. Didn't feel confident, they just didn't stop. They kept investing through the noise, through the fear, through the months that felt like a mistake, and that was enough. The other, they weren't careless. They were careful, they waited, they tried to be smart, but they waited for certainty. And by the time it showed up, the opportunity was already gone. The truth is simple. The person who built wealth didn't predict anything. They just didn't stop. And looking forward, the next decade won to reward the smartest people in the room. It won to reward perfect timing. It won to reward people who feel ready. The next decade's wealth gap will be created by who acts during uncertainty, while everyone else waits. The window does stay open forever. The best opportunities never feel comfortable. And the truth most people learn too late. You don't miss wealth slowly. You miss it all at once.